Christian from IG Markets is joining us from Melbourne. Chris, good morning to you on this Friday. Look, we had a lot of central bank action through the overnight period, the BOJ, the BOE, ECB, and of course all of that economic data coming out of the US. So tell us about bond yields and what they're telling us.
Well, I mean, it was Akron City last night, wasn't it? I mean, the ADPs and whatnot. So, I mean, I think what we're seeing now is global growth is very much at the forefront. I mean, if you look at G10, the markets or the sort of consensus is around about 3% for next year. But the bond market is not just pricing out ultra easy stance from the Fed, but I think they're also looking very much at growth. I mean, we've seen some extraordinarily strong numbers coming out of the UK over the last couple of weeks. The services ISM a couple of days ago was at record levels. Construction and their manufacturing PMI numbers are really coming off a low base, but they're really, really strong compared to a lot of the emerging markets and also, you know, the global numbers. We've seen expansion coming through in the PMI series in the Eurozone, with the exception of France. And Germany looking very strong there. Some of the new forward-looking indicators, like the new orders, looking good. And of course, the services ISM numbers last night in the US were the highest numbers since 2005. If we look at the employment subcomponents, these ISM numbers do have subcomponents. If you look at the subcomponent of the services ISM last night, the employment subcomponent came up to 57 from around 53. Now that's thematic of a non-farm payrolls number tonight, well above 200,000. The concern or the offset that I have there is the ADP number, which we saw coming out just over 170-odd thousand last night. The ADP has traditionally had a very strong, reasonable correlation with the non-farm payrolls in terms of predicting direction, but has outperformed on a numerical basis against the non-farm payrolls, you know, since the 2009 low. So unless we see the first outperformance of the non-farm payrolls, you'd expect that number tonight to come out between 150 and 170,000. Although, as I say, the offset there is that the ISM services number suggests a payrolls number tonight above 200,000. But clearly, we're seeing that in the bond market now. I mean, we saw the 10-year US Treasury push up to 299. Well, for all intents and purposes, was 3%. It was a rounding error, and that was significantly up about 10 basis points. If you look in the UK market, the gilt market, that pushed above 3% for the first time since 2011. The Bund market in Germany, well above 2% as well. That was up around 13 basis points. There was a big sell-off coming through in developed market bonds. I mean, we should see the Australian 10-year open a bit later on today and trade above the recent high that we got on August 22nd, which was, I think, around about 412. We're about 5 basis points short of that today. So we should see the highest level in Australian bonds for some time today. But it's not just that. We're seeing a big move in the front end as well. You know, the US Treasury 2-year, for example, now trading at 51 basis points. Yeah, if you think back to May, that was trading at 20 basis points. That's a massive sell-off as a percentage basis. If you look what's being priced into ththese markets now, we've got to remember that the ECB, the Bank of England and the Fed are all giving forward guidance, but the market's just having none of it, to be honest. They don't believe that rates are going to be kept low for an extended period of time. They believe the markets, the central banks are going to move well before that. If you look what's being priced in the US now, the Fed funds rate by June 2015, i.e. what the market expects for rates from the Fed funds by June 2015, which is when the Fed have actually directly said they want to start putting up interest rates. The market's now pricing in 92 basis points. That's 3 rate hikes when the Fed are going to potentially start. So that's a huge, huge disconnect there. In Europe, if you look at the ECB, they're saying that they want to keep him probably for 2016. The market expects rate hikes in 2015. And in the Bank of England, where they say they want to put rates up when they get unemployment at 7% by 2016, which is what their forecasts are, they expect rate hikes in 2014. So clearly, you know, what we're seeing now in the bond market is markets are saying that growth is going to continue in this fashion, and these central banks are going to have to move a lot quicker than they've been saying.
If we see these the tapering happen come September, in the post-tapering world, basically, are we going to see these recoveries in developing markets and these rising rates really derail equities?
Well, we've got to look back. I think it depends on the level of growth that we see. I think tapering's now fully in the price of US Treasuries after the manufacturing number we saw at the beginning of the week in the US, and of course last night's ISM services number. You know, if we saw a really, really weak jobs number on Friday, perhaps sub 130, 140, then perhaps, you know, that can get pushed back. There are issues such as emerging markets and Syria, which all potentially play into the Fed's psyche, but probably not that much. We've got to remember that over the course of time, rising bond yields have coexisted and run alongside rising equities. generally rising bond yields means there's growth, and of course, growth is really good for equities. Inflation is generally a good breeding ground for equity appreciation as well. So it depends if we get back to that situation. I think that's why we're not seeing such big panic in the equity market last night. If we think back 2 weeks ago, we would have seen a big sell-off in the equity market if we saw a big spike up in bond yields, because people are just saying, the mortgage repayments and housing and bits and pieces will suffer because of that. Now, I think global growth is very much in the crosshairs of the market psyche right now, especially predominantly in the developed market side of things. And perhaps people are saying, well, if we are going to have this growth and it continues in this fashion, perhaps equities will be a good place to be, and perhaps the growth will be resilient enough to absorb some of the shocks that we're going to see throughout September and October. But I'd still stay relatively, not neutral, but probably a little bit bullish. But I'd still stay relatively cautious, given the situations we have. We know that Greece will probably get another bailout. There's talk that there's going to be a decision made in November. We know that the debt ceiling, there'll be a lot of political jousting going into mid-October when they run out of money effectively, and there'll have to be some short-term money markets. Whether or not they can fund or get the money to fund those money markets is yet to be seen. Syria is still to play out, of course, and that will keep people from really going massively underweight the yen. There's some big issues, of course, the German election, which I don't think will be that big a deal. But I think the other big situation is what happens in Europe with the German Constitutional Court ruling on the outright monetary transaction in October as well. And there could be some consequences around that, which sees the euro coming off quite sharply, and perhaps some of the European markets underperform.
And political instability in Italy as well.
Of course,
so lots on the agenda. Let's get to the here and now. For the local market today, of course, we have the election tomorrow, Chris, and of course we have the non-farm payroll data expected in the U.S. tonight. So what are we going to be looking to through the day today?
Not a lot, to be honest, Nadine. I think today's one of those days where you can sort of write it off. Volumes will be pretty low. I'd imagine we'd be seeing somewhere between 4 and 4.5 billion if we see that. The open we've got for the market is very slim today. We're looking for an 8-point gain on the market. Gains a gain. We'll take that every day of the week, but it's going to be about 8 points. The Japanese yen market's going to be very interesting. We're calling that up about 20 or 30 points, which is a very low percentage gain. But the dollar yen now, interesting given the correlation with the Nikkei, is pushing into that 100 level. Whether it can reclaim the 100 to 105 range will be certainly very keenly watched by Japanese traders. And a big move up into the back of the day in the Nikkei and potentially the Chinese market could see some life into our market. But with the non-farms tonight and the potential ramifications that could have on tapering and bits and pieces in the global economy, and not to mention I suppose the election, but I think that's fully in the price now. There's every opportunity for traders just to write this off and sit on their hands into the back end of the day. There's not a lot of corporate news to really look out for. If you look at BHP's ADR, that's pointing up about 8 cents. And I think it's going to be one of those low volatile days where people are sort of just really trying to work out what the whole sort of situation now means with global tapering, emerging market trades, the macro sort of headline risk in September, October, and just see what it means for their portfolios at the moment.
Chris, while we have you, we've had the Bank of International Settlement releasing its foreign exchange report, and this one's only done about every 3 years or so, and it's really interesting because not only have we seen trading surge to an average $5.3 trillion a day, we're also showing a massive jump in Australian dollar transactions. So just give us a bit of context of that, and I guess tell us why.
Well, the Bank of International Settlements, like you're exactly right, do this report every 3 years, and it's closely watched by the market. It gives you a good sense of where the flows are, not just in terms of a currency perspective, but from a geography perspective as well. If you get the UK, the US, Japan and Singapore, they may account for 71% of the daily turnover that we see in the FX market. That $5.3 trillion that we saw on a daily basis now is about a 33% increase from the last time they brought this survey out back in 2010. And that 2010 survey was a 20% jump. So clearly the daily foreign exchange turnover is increasing dramatically. I'd imagine we'd have this conversation in another 3 years, and it will probably be up 20 or 30% then as well. A large portion of what we saw in terms of that big spike is really premised on the volatility we saw in 2011, 2012. there was a massive spike in volatility. If you think back, Goldman Sachs, Credit Suisse, a number of the investment banks have always talked about a spike in volatility being very, very good for their trading volumes in terms of their currency exposure and their currency transactions there. But I think what's really interesting now, if you actually look at the daily flows that Bank of International Settlements have portrayed, and let's remember they have surveys a pretty wide audience. I mean, they've 53 jurisdictions. They've sampled over 13,000 different banks, investment banks, retail banks. So there's a pretty wide sample there. We know that 87% of all daily transactions are done over the US dollar. The Aussie dollar went from around 7% in 2010 up to about 9%. So its role in the global, as a global currency, has increased. We know it's been increased put in that basket of its own currencies in its right as well. The big drop-off was really in the euro, with 39% back in 2010. It's now 33%, whilst the yen's also seen a big increase. But what I think is really interesting as well, Nadine, is that Singapore now is the biggest foreign exchange hub in Asia. It's overtaken Japan. So, you know, just because of the time zone and the big players that are there now, Singapore really is where it's at in terms of FX in Asia right now.
Interesting. Okay, Chris, thanks so much for joining us. We'll check in with you a bit later on.
Thank you.
Chris Weston from IG in Melbourne.